right, it is 3 o'clock. And so let's go ahead and get this webinar kicked off. My name is Jeremy Constantino. I'm the Investor Relations Manager here at Ackerman Group. And today you are all calling in to our live webinar for our latest acquisition and addition to AMF Funds 2 portfolio, the Reserve at Hamburg. So the agenda for this presentation is as follows. First, we'll kick it off with Chris Conan, our Chief Investment Officer, and he will give a quick update of our AMF Fund 2 portfolio and status. And then he'll go ahead and introduce this new property, the Reserve at Hamburg, and talk about the investment strategy. Then Alex Cole, our acquisition manager, will discuss the market strategy. And then we'll turn it over to John Wendt, our Chief Financial Officer. We'll talk about the economics and the debt structure. Then I'll take it back over and talk about the next steps and the timing of when we're going to close on this excellent property. And then we finish with a live Q&A. So it's a live webinar. We encourage you to utilize the Q&A button here in the Zoom webinar. So the Zoom webinar feature that we're using, you're not going to be able to speak your questions, but you can go ahead and type your questions in the chat button, and I will be monitoring those the questions throughout the presentation. So feel free to go ahead and start typing in your questions in the Q&A button throughout the presentation, and then we will answer the Q&A, the questions towards the end of the presentation. So on this call, we have basically 3 groups of people. We have investors that have already invested in AMF Fund 2. So we welcome you. Thank you for joining us on this call, and you can learn about where the status of the AMF Fund 2. Also, we have investors that have invested into other Ackerman Group investments, but have not invested yet in AMF Fund 2. So we welcome you and thank you for calling in. And then lastly, we have new investors that are potential investors with Ackerman Group, and we welcome you. And hopefully we'll be able to partner with you maybe on this in AMF Fund 2. And if you're looking to allocate, we welcome you and maybe love to partner with you. Therefore, this presentation is very high level, and if you want additional details in addition to this high level overview, we encourage you to please reach out to me and Chris, and we can set up one-on-one meetings with you to go further in detail. With that, I will turn it over to Chris Conan, our Chief Investment Officer, and he will talk about AMF Fund 2. So go ahead.
Great. Thanks,
Chris.
Jeremy. So first, I'm going to give you an update on where we are in Fund 2. As of the end of next month, we will have raised 28% of our target capital raise of $200 million. All the funds that have been raised have been deployed into our first 2 investments: Britton Woods Apartments up in Dublin, Ohio, a great suburb of Columbus, and then Reserve at Hamburg, which we'll be closing on next month, in Hamburg, which is a great suburb of Lexington, Kentucky. As we've communicated in prior to you, our return expectation for the fund is 8 to 10% annualized yield over the life of the investment over the 10 years, and a mid-teens total return. Historically, we have achieved an average annualized net cash return of 22%, including supplemental loan liquidity events throughout the investment hold period, as well as a 19% net IRR to investors. AMF Fund 2, if we want to go to the next slide, Jeremy. So AMF Fund 2 is focused on stabilized properties that are cash flowing positive and have room for improvement. The improvement in the form of physical renovations, or in the case of a core plus investment strategy, it's in the form of improved curb appeal and systems and processes for more efficient operating. If we go to the next slide, Reserve at Hamburg is a value add strategy. We are going to utilize our rapid renovation program to renovate the 318 apartments. Now we're renovating the kitchens and bathrooms, and we're going to be able to do this in one day per apartment. So that allows us to get through 318 units in 3 to 4 months while they're occupied. The current resident will leave their apartment in the morning at 6 a.m. We'll ask them to leave at 6 a.m. so that we can get in there and get started. And then when they get home around 6 p.m., they're going to have a new kitchen, new bathrooms, and new lighting throughout their apartment. The rapid renovation program allows us to maximize net rental income during the construction period and shortens the construction schedule by over a year, which alleviates turnover among our site staff. It's a very grueling process, and if it drags out into multiple years, which it does, as you're turning units or renovating units as residents' leases come due and they move out, it becomes very grueling on the site team, as well as the other residents at the property. So we've done this over several thousand units, and it's been very successful for us. We can go to the next slide. So Reserve at Hamburg, we're really excited about this, and primarily because of its location. Alex was just at the National Multi-Housing Council annual meeting out in San Diego, and he was meeting with a real estate broker from Lexington who had nothing to do with this transaction. And Alex, you can tell a little bit later, but he said this is the best location, the best corner in Lexington. And that's the way I feel every time I drive into this property. So location is number one. That's what we were so excited about. Hamburg is located on the east side of Lexington and offers a lot of shopping and dining and entertainment amenities. Also, we got this at a good price. It's well below the replacement price today. And you'll see those numbers here shortly from John. But additionally, when we look at newer vintage, which this will compete with post-renovation, we're considerably lower than where newer vintage assets are selling today. And we can highlight that again later in the slide deck here. So with that, I'm going to pass it off to Alex to talk a little bit about the market and why we like it so much.
Yeah, thanks, Chris. So as Chris mentioned, we're really excited about entering the Lexington market. We've always said that we like the market, but it would take the right deal to get us there, and we finally found the right deal. So from a strategic perspective, this deal does a lot for us. First, we can enter a new market in the Southeast, but it's close enough to our base in Cincinnati that we can operate the deal efficiently. And then also it extends our reach closer to the other markets in Tennessee and the Carolinas that we've been targeting that fit our investment thesis. Next slide, please, Jeremy. So here are just some overall market highlights for Lexington. And honestly, there's a lot to like about the market overall, but especially from a jobs perspective. Lexington as a market aligns with kind of an eds and meds strategy. There's a major university, the University of Kentucky, that employs over 20,000 people, and there's 6 different hospital chains as well. Along with education and healthcare, there's also a large proportion of manufacturing and local government employment as well. An example of this is Toyota, who has about 10,000 employees in Georgetown, and the state of Kentucky actually employs 11,000 people in the Lexington area. So we love this employment profile because generally these jobs are sticky and they require employees to come to their place of employment and live in the market. And then drilling down a little bit to the Hamburg submarket. I mean, Chris mentioned the comment about best corner in the MSA. I really believe that. I mean, it checks all the boxes for us. The property is close to all the destination retail, close to the highways, which allows tenants easy access to all the employment in the MSA, and it's in a really good school district. Next, please, Jeremy. From an apartment market perspective, Lexington has very positive fundamentals. Currently, the overall market is about 95% occupied, and we really don't see that changing as employers are adding about 4 jobs for every 1 apartment unit that's being delivered by employers. But just kind of as an overview, low current vacancy, a lot of new jobs, and not a lot of new construction means stable rent growth for the foreseeable future. And I'll pass it over to John.
Thanks, Alex. Good afternoon, everybody. Quick synopsis of the deal. We're buying it for $47.3 million. We're going to put about $8.5 million in it, and with closing costs, we're in for a little over $56 million. But the more important number here is the $177,000 a door. If you were to build new, it would be over $250,000 a door. And there's even another used property that just came on the market that's over $200,000 a door. So with this cost structure that we're getting in for, we can remain competitive going forward because we bought in a little bit less. You can see in the left-hand corner there in the sources and uses, the loan's a little over $29 million with about $27 million worth of equity. So again, a pretty conservative outline there as to how we're getting into this overall deal. Average cash on cash yields in this deal are about 8.5% with a little over a 14% gross IRR, or for those of you that track it, an equity multiple of about 3.7 times. It leaves great room for us for our very traditional plan of doing supplemental loans. Again, for those not familiar with that, Freddie Mac allows us to go back and re-leverage the deal to where we underwrote it to begin with, and then turn around and pull that money out, non-recourse, and give it back to the investors to de-risk the deals that you don't have as much invested in that particular deal. It's all non-recourse. The debt structure on this is going to be roughly 5.8% all in right now. And what's nice about that is we locked that rate in last week. We're not at risk for that rate at all. So we're not taking those interest rate swings because last week rates were down about 3.8% on the 10-year Treasury. And today I think I saw them up near 4.15. Well, we locked that in last week. We're not at risk for it. And for the next 12 years, we're not having that risk. Freddie Mac's confidence in this deal also allowed us to gain the full 12 years as an interest-only period, which just allows us to return that capital in the annual returns back to the investors. So for us, this is just a great deal for getting into a new market and being able to generate those steady returns, both in the short-term cash on cash and the long-term in terms of the overall internal rate of return on this.
And can I jump in real quick? There's a few things here as I'm looking at the presentation that we didn't really want to drill down into too much detail. So I'll highlight a couple things here, and then if you all have questions, you can ask. But we could also you can call us and we can answer them. But on from a rent perspective, Alex, can you talk a little bit about where we are in the market today when we look at the scale of competition, and where that puts us once we complete our renovation? I think the number I saw was $180 premium today over where rents are after it's renovated, and then the rent growth going forward. Sorry to put you on the spot. This wasn't planned, but you've been working on this. I know you've got this in your head. So.
Yeah, no problem. So at the end of 2 years, we think the renovation premium on the improvements that we're making, as Chris said, is about $180. And the good thing about that is there's other value properties that have completed value adds in the area, and we stack up very well against those deals and are probably a little bit better located. So we think we can probably outperform those deals. And then additionally, there's very little new construction coming into the market, but we're still under the new construction. So a renter who's looking to move to Hamburg may see some newer apartments, but we'll be able to compete on value against the new stuff, but we'll be able to be very competitively priced against the other renovated products. So we really have found a really nice little position in the market that we think we can take advantage of, and it will also be very compelling to renters in Hamburg.
Thanks. And then I will mention that we look back when we look at after the renovation, we put a premium on that, and then we look out long term. Where do we think annual rent growth is going to be over a 10 or 12-year period? The fund is a 10-year period. We do finance between 10 and 12 years, depending on the terms. We can always sell and pay down the loan a couple of years early. But when we look out 10 years for the whole period of this investment, we're looking somewhere between 3 and 5% average annual rent growth. And we take COVID out of it, and we look at a historical average pre-COVID, and that's where we're coming up with those averages. So I think we're in the high 3.75 maybe on this one long term. That's on an annual basis. So relatively conservative for when we're looking at historical and really ignoring the incredible growth that we experienced during COVID.
All right.
Jeremy?
All right. With that, let us talk about the timing for the acquisition. So today's February 5th. We're having this live webinar. And in roughly 2 weeks, for those of you who would like to invest into this acquisition and be a part of AMF Fund 2, we're asking your subscription package to be completed by February 16th. So that gives you about 2 weeks to get your subscription package executed. And even if you are in AMF Fund 2 already and you would like to increase your amount of allocation in this next closing, we are asking that you do another subscription package. So that's really important to remember. Then on March 1st, we'll be calling the capital for this closing. So that gives you from today about a month to get your funds in order and be ready for to wire the funds on March 1st. And then we'll be using that capital, deploying it on March 22nd to close on the reserve at Hamburg. So next steps to invest, if you would like to invest or increase your allocation in AMF Fund 2, is simply just reach out to Chris and myself. And there on the screen is our contact information. So
Jeremy?
That is our presentation. Like I said, it is a very high level presentation, but we are doing this as a live Q&A, and now is the time to ask a couple questions if you would like to take advantage of us being here and ask some public questions. So give you guys a couple
and
minutes.
while we wait for those questions, I will just mention real quick on AMF 2, you will invest in the fund, which will own a portion of every asset that we buy. So your investment today will own a piece of everything we buy, and we expect to have, depending on leverage, somewhere between 10 and 12 properties very similar to Reserve at Hamburg in the fund. So it provides good diversification. We're looking in Ohio, Kentucky, Indiana. We're looking in the Carolinas and Tennessee. So our goal is to create diversification through the acquisition process. Looks like we've got some questions here.
All right. Yeah. Thank you guys for starting to put some questions in the Q&A box. So let me go first. The first question is there a prepayment penalty to pay off the loan?
I
John,
can
you wanna
certainly
take
take
that
that one. Yes, there can be. We have an open window prior to maturity that allows us to pay it off without any prepayment penalties. But the prepayment goes down as the loan goes down and the balance as well. And it factors in where our current interest rates in the market, as the people who bought the loan have they can repurpose their proceeds and earn out on that. And so from that standpoint, right now we'd be in a position on most of our loans in our portfolio, there would be limited to no prepayment penalty. And so this one may be in that same scenario, depending on where interest rates are. Say if we wanted to pay it off 7 years in, we could pay it off. But there would be some prepayment. And we've done that before over our life cycles here because it's worthwhile, whether it's the market we change our mind on or whether it's just a good time to get out in the overall market. We have done that, but we have the flexibility and would factor that into any decision we would make.
Excellent. Thank you, John. Okay, next question. Can you speak about your strategy for the sidecar investment, i.e., i.e., amount you hope to raise?
Sure, I can take that one. So we do have a sidecar investment in most of or all the investments we're going to be putting into Fund 2. And this is an investment vehicle with a minimum of, I think on this deal, I think we had a $2.5 million minimum with a $4 million maximum. And these are individual investors who want to come into one particular property. We ask that you invest in the fund at the minimum, but you also can come in on the side into one particular deal if you really like it. And it really does play into people who have 1031 exchanges that they need. Seems to work well for that group primarily, and others who are a little more sophisticated and really feel great about a specific particular asset. So we would expect to have anywhere from probably, no more than, I wouldn't think, $20 million in any one particular deal. It just depends. We are limited to how much we want to bring in because the lender will have certain requirements. If one particular investor is investing over 20% of the total equity. So we try to keep it down in the 10 to 15% range for any one particular investor. But this also allows us to extend the capacity of the fund. If we're getting leverage right now, at this deal, we're at 64% loan to value, I believe, or 65. Some of I think our first deal in Fund 2 was at in the high 50s. That's pretty low leverage, and so this allows us to maximize the diversification and get to bring in 10 to 12 properties.
Okay, great. Okay, next question. Can you repeat the details about the debt structure for this deal? So what I'll do is I'll go back to that.
Go back. And John, if you don't mind taking this and talk a little bit about the primary loan and then some of our plans for the supplemental opportunities and how those come about.
Absolutely. So when we close, out of the 56 million, we plan on borrowing a little over 29 million. And so that's what creates what's on this page is 52 to 48% in terms of the loan to cost and the corresponding equity amount to fill that balance. That would be regardless of any sidecar players that would fit into that. The 29 million really doesn't change for that. At the same time, we generally pro forma in looking at supplementals at the end of year 2, 3, and 6. Not that those are magic years. We can look at this once every 12 months, but as you go further out in time, the net effectiveness of it due to the lapse of time, it just isn't available anymore. But we would pro forma right now just under 10 million of supplemental loans spread over those 3 supplemental periods. Again, the end of year 2, end of year 3, and the end of year 6 is when we would look at those transactions happening, which then we generally look at those as sending those out to the investors. We may hold some back if there's some other capital need, but yes, that's what we are doing. So then when we sell it, the property, which is going to sell for a little over $70 million, we're netting about $50 million of net proceeds, net of paying off the debt for this.
And that would take our debt up to 69% loan to cost. So we're not stacking a lot of leverage. These are smaller tranches of debt that layer on top of the original debt, and they run side by side on term and other than rate. The rates are typically about 100 basis points higher than
correct.
market.
And the lender actually puts a cap on that, and I believe our cap on this one's going to be a 65% loan to value, not loan to cost, but a 65% loan to value cap on it, even in the future deals. So we can't leverage this way up. We have to stay right in the range where we're going to be when we close. And this may be a loan to cost right now, but on a loan to value, we're in the low 60% range for where this is coming out. And so we have to stay right around that same number throughout the life of the loan because our underlying interest rate and interest only periods are based on the fact that we've got a pretty conservative loan structure.
Yeah. And John mentioned, this de-risks the capital position for investors in the deal. It also gets the bulk. It lends to getting a lot of the return back to the investors, and we're not as reliant on a speculative exit price on the asset. So we like to get that return out as quickly as possible and get as much of it back to investors before we sell, so that we're not relying on a major speculative sale to hit our return threshold.
Okay, we still have a handful of other questions coming up, so let's go through them. Next one is, please remind me of the minimum investment amount in the fund. I think it's $100,000, but wanted to clarify.
Yeah, we have a minimum of $250,000 in Fund 2, and generally we're calling all of that up front, or when you sign the commitment, we're going to call it all for this closing. If an investor comes in with a 7-figure number and wants to time the capital calls, we can do that for you. We ask that the 250 be the minimum for each call, but we can spread out those calls if you need to time your liquidity to make the capital call, or to meet the capital call. So 250 minimum, and then as we get over $1 million, if you would like to spread that out over a couple of capital calls, we can do that.
Okay, another question. What about sidecar investments with the fund? How much is needed? I think we touched on that, but Chris, if you want to add it, another comment.
No, I think that's it's not needed. It's another vehicle, because we have found that there are people out there looking that would prefer to be in an individual investment or asset, or that need a 1031 exchange. And we believe that it benefits the greater whole of the fund and our investors, because it just gives us a little more capital to go make sure that we can get as much diversification as possible.
Okay, great. Next question. I got into Fund 2 last year. Since the first Fund 2 investment was in April, will there be any distributions coming from that investment?
Yeah, I can. So current investors in Fund 2, the first acquisition was in April of 23. Typically, it takes about 6 months to gather enough cash flow to make sure we have enough cash on hand to fund our capital reserves and have cash to distribute to investors. So we would expect, and we have a meeting coming up in the next couple of weeks to look at this, but we would expect to be distributing here in February from the fourth quarter of 2023 on Britton Woods. So that would be your first distribution from Britton Woods here in February 15th, which is our fourth quarter reporting deadline.
Okay, thank you.
And I just really elaborate on that for anyone new on the call. We're only buying stabilized cash flowing assets. We're not buying distress. So when we buy a property, it's generating good cash flow. And we like that because it allows us to put out a regular distribution as early as possible in the cycle of these investments.
Excellent. Okay. Next, I think this is the last question. And if any attendees have any more questions after this, we just got one more question. Can you review the uplift or rents due to the renovation and current rents that are below markets? Thanks.
Alex, do you have any? I think what they're asking is the rent increase on the renovation, and are any of the rents at the property currently below market?
Yeah, so I would say the rents currently are, or maybe a hint below market. I mean, their occupancy throughout the past 3 years has run at about 97 or 98%, which is tighter than the overall market. So that tells me that the rents are a little bit low, and they're managing for occupancy rather than to optimize revenue. But as far as kind of the numbers behind the renovation rents, we're planning on getting $180 a month a unit for the renovation premium. We expect to get that within the first 2 years. So we think we know that's a good strategy, because there are other renovated properties in the market that are frankly not as well located as Reserve of Hamburg that are getting that kind of renovation premium. So from a business plan perspective, I think it's very, very executable.
And I'm going to elaborate a little bit on the rapid renovation and the timing of the rent premium. So we will go in. It's a really interesting process to actually go see, because we renovate so quickly and we're doing it in occupied units. The tenants who are getting a renovated kitchen and bathroom the first week of our renovation kickoff may have a lease that lasts another 6, 8, 10 months. They get to live in that apartment at their current lease rate for that period, and then they can choose to renew at that $180 premium, or they would move out and we could go in and finish any touch-up work, carpet, if there's certain features that need a little bit of an upgrade to get that apartment to a fully renovated state, we'll do that. And we'll even tack on a little bit more of a premium if we think the market can handle it on a new tenant coming into that renovated unit. But we have found also that when someone's been living in the unit for several months or 6 months or 8 months with the renovated kitchen and bathroom and the lighting and flooring, they tend to want to renew their lease, even depending on, whether they can afford the premium or not, but typically they can.
All right. I think there are no more questions. And with that, we can wrap up. So again, this was a high level presentation just to give you guys introduction to the property and the status of AMF Fund 2. So I encourage you all, if you're interested or have any further questions and want to have a conversation with Chris and myself, please call us and please email us, and we can schedule a subsequent meeting with you. So thank you all. And Chris, do you have any final words?
No, I think if you're new to what we're doing here in Fund 2 and haven't received any information from us, please do reach out and we can send you our prospectus, and would want to get on a call with you or meet in person if possible to kind of walk you through our program and the success that we've been able to have over the last almost 2 decades.
All right. Well, thank you. Thank you all for attending, and hope you have a nice rest of your Monday afternoon.